I think we live. Let me see.
Let me ask the chat. Put a
Yeah.
one in the chat if y'all can see us.
Uh-oh. You're this is what you love. I don't it's funny. Mine still says upcoming. Am I tripping?
I think we're live. I think.
We'll find out soon enough, right? Get enough people yelling.
Yeah, it says we're live on YouTube, so we're live. Okay, I
Cool.
see us. All right, awesome. We're
What
here.
up?
What's up, y'all?
Tim, man, you gotta get us with this StreamYard, bro. I thought it was easier than this.
Yeah, I thought it was easy too. It's not easy. Okay, so there's a bit of a lag. Okay, that's why. So they're putting ones in the chat now. Okay, so they can see us. Cool. We're here. All
Morning,
right.
everybody.
We got y'all up early, ready to learn.
Psh,
Hopefully.
man, me early. 10 o'clock for y'all.
Okay. Cool. How do we share our screens? Okay, so
Oh,
share. Do you see share at the bottom?
yeah.
Okay, cool.
You can share first. It's all good.
Oh, you want me to go first?
Ladies first, why not?
Okay. All right, y'all. So me and P Dub are back from the shadows, and today we're going to talk about, a little bit of psychology, a little bit of trading plans, a little bit of rules, and that's where I struggle the most. So I'm going to share. Let me see. Share screen. Um,
It's usually all right
can
if
I
you.
share a window? Okay, good. Here we go. Okay, so they should. I think they can see my screen now.
Yes.
So obviously the market, and I'm not actually going to use this chart. I'm just going to type on it, right? So if we're talking about a trading plan or a trading model, so let's say you watched our first video and you're like, cool, I understand this setup, but I can't implement it right. Like you can know every setup in the world and not be able to trade. It's because your mental isn't there. It isn't prepared and ready to take on what you're doing. So, and I've struggled with this myself. So it's like I can know, I know to buy here and I know to sell here, but what keeps me from chasing price, or what keeps me from jumping in when I'm not supposed to? So you want to start off with some rules, and let me make this black. So these are going to be our trading rules, and this is literally what I've done for myself. I've just created a personal Discord. Did we lose P Dub? Is he here? Okay, he's back.
Yeah, I don't know. It
Okay.
just clicked out or something weird.
I created a personal Discord, and I basically put all my rules in there. So like, you have a trade setup and then you have a trade model. So your trade setup is, oh, if I see this breaker, if I see this order block, I'm gonna press buy or sell here. But your trade model is, well, which order blocks and which breakers are you gonna sell? So then that comes with rules. So in your rules, you want to have things like, what times or sessions am I allowed to trade? And let me do this so we can see this, right? So what sessions am I allowed to trade? Because if you don't have this, you're going to be all over the place. You're going to be trading anything like under the sun. You're going to be at the Asian session. You're going to be at 3 a.m. You're going to be at London. You're going to be everywhere. And that's not good because you literally can just blow your account because you're trading everything that you see and you're not trading high probability. So trading is one part process, one part probability, and that equals profits. It's not the other way around. It's not, oh, price is moving, let me jump in. So I started off with, what sessions am I allowed to trade? What time can I trade? And we know that time and price is important. So that's something you have to figure out for yourself. When are you able to trade? You might not be available at 9:30. You might not be available at 8:30. You might have to trade to London, or you might hate trading to London. So choose a session. You don't need 30 trades a week. 3 to 4 trades a week is all you want. It's all you need, really. You can trade more than that if you're a scalper. Let's say you're only going for 3 points. Okay, do you? Whatever, if your setup allows for that, do that. But you don't need a whole lot of trades. That just gets you in a spiral almost, right? So what sessions and what times am I allowed to trade? How am I going to feel when it's time for me to trade? So how, am I allowed to trade when I'm angry? Am I allowed to trade when I don't feel well? So what does your mood have to be when you trade? So for me, I'm not allowed to trade when I don't feel well. So if I'm sick, I can't trade because I'm not thinking clearly. I'm already like barely breathing probably if I'm sick, right? You don't feel well. Why would you turn the computer on? You wouldn't go to work when you're sick. Why would you trade when you're sick? Same thing. Or let's say you're angry at somebody. Someone pisses you off and you get mad. Why would you trade when you're pissed off? That you're going to take that out on the market, and it's not going to go well because the market is going to abuse you. Like if you think you're going to punch the market, it's going to punch you back. So what does your mood have to be? That's important. What are your goals? You can't trade without a goal. So like, let's say, and I heard Jay the Trader say this, I'm gonna give him all the credit. If you don't have an end goal, you're just trading aimlessly, right? He used the example of if you're running on a track, imagine going to a track meet and you're supposed to be watching the 100-meter race, but it's not 100 meters. They're just running. Like imagine just watching people run and there's no finish line. That's not fun. No one wants to watch that, right? So if you don't know where the finish line is, how do you know when to stop? So imagine people just running in circles, running in circles. There's no goal. There's nothing in that. You're not getting anything out of that. So you need to know your goals. And inside of that, inside of your goals, you can have things like, what's your risk to reward? What is your weekly target, right? So let's say you have a $100,000 account. Let's say you're starting with your SIM account that's $100,000, but it's real life, right? Let's say you want to make 3% a week, which is $3,000 a week, right? If you don't know that you want to make $3,000 a week, let's say you make 5,000, and then you keep trading, and then you end up negative 2,000. When in reality, you could have gotten your 3% and been done and not exposed yourself to that extra risk. So the reason you have a goal is to not expose yourself to risk that you don't need. So do not expose yourself to extra risk you don't need to take. And that's why goals are important, right? And you have to have a goal for when you lose too. So let's say you lose 3 times in a row. Are you going to keep trading? Oh, I got to get it back. Oh, I got to get it back. I got to do this. I got to do that. No, you don't. Sit down. So you need to have a goal for when do I stop if I am losing? Because you ever been in, I know you have, I have. Let's say it's a day, right? And you missed the first trade. Your setup was there perfect and you missed it. Let me slide this over so y'all can read it. Let's say your trade was there, right? It was perfect and you missed it. So already your mental is a little shaky because you're like, I got to get in. So now you're fiending to get into a trade. So you take a bad trade because it's not your setup. Your setup was already there. You missed it. So do you have a rule to say, well, I'm not allowed to chase price, or I'm not allowed to get in unless my setup is A+, right? Unless it's absolutely perfect, I'm not going to get in because it was already absolutely perfect once. What are the odds you see 2 perfect trades in one day? Not good. 9 times out of 10, you're not going to see it. And if it is, it's not going to be like 10 minutes later when you're thinking you're ready to get into a trade. So if you're losing, when are you going to stop? You have to be real with yourself. You have to look in the mirror and say, okay, if I lose 2 trades in a row, I'm done for today. And I'm going to come back tomorrow when the odds are better and the probabilities are higher that I'm going to take a successful trade. Let's say for the week, when am I going to stop if I'm losing? If I lose 3 trades in a row in a week, and let's say I'm risking 2% per trade, I've lost 6% of my account this week, I'm going to stop and try again next week. Because if not, you're just going to keep going. And you're going to get into your emotions and spiral and spiral and spiral. And then your account's going to be at 0. And then you have no choice but to stop. And I've done that. We all will do it. We're human. So these are key important things. You have to have your goals. You have to have your trading rules. You have to have your times of the day. And then on top of that, you have different versions of your setup, right? So what are your setup rules? So let's say you're trading a breaker. Let's say you usually trade a breaker on the 15 minute, right? Okay, well, you missed your 15-minute breaker trade. It already formed and you didn't get in. You were doing something else. You weren't looking at the chart, whatever. So now a 5-minute breaker trade forms. But you don't trade 5-minute breaker trades, not usually. You don't know how price is going to react. You don't know how long it's going to stay in that breaker. You don't know if it's going to come back up a little out of that, wick out of it a little bit. But you get in it anyways because, oh, it's a breaker. I missed my trade. I got to get in. Is that your setup? Are you being realistic with yourself saying, okay, maybe I can trade this. Maybe it's just going to go down. It's the same thing. It's, you're lying to yourself, right? We've all lied to ourselves to justify the trade that we're taking. And when you do that, you're only detrimenting yourself and your account, right? So what are your setup rules? You have to have these lined up. Like, what time frame am I allowed to trade on? Because trust me, sometimes I don't see it on a 5 minute, but I'm like, well, if I go to the 2 minute, it might be there. And then I see it on the 2 minute, right? And then I take it on the 2 minute and I get clapped. You know why? Because it wasn't there on the 5 minutes. Don't let those time frames lie to you like that, because they will. And you're allowing them to, because your emotions are clouding your judgment and you're trading based on what you feel and not what you see. So what time frame am I allowed to trade on? What stop losses am I allowed to have? So I know I've done it. You ever move that stop? You ever been in a trade? Peter, have you ever done this? Have you ever been in a trade and you're like, well, I'm gonna risk 5 points, and then you start taking heat, you at 4 points, right? And you're like, well, I really can risk 7.
I mean,
well, I really can risk 10.
Realistically, I can do 10. Yeah, of course.
You justify what you're doing. Yeah, exactly. You justify what you're doing based on your feelings.
You know, the other one that people do is they drag it down and they go, you know what? Let me add a contract and bring my average down. Instead of saying I'm risking more. They don't even realize they're risking more money. They're just like, you know what? Let me bring my average down, because then I'm gonna catch it on that retrace and get out.
Exactly.
What you never do.
So you add that contract, you move that stop down, you widen your risk. Or let's say your daily loss limit is, 10 points. Let's say that's what it is, right? So let's say, $500 if you're on the ES, $50 on the MES, right? So let's say you're only supposed to lose $50, and that's your risk for the day, and then you go home. So you lose that trade, and you lose that $50 or that 500, right? You ever justify getting into another trade? Like, well, I lost. Well, it's only $50. It's only $500. I realistically I can lose 1,000 today. As soon as you start to do that, you going off the deep end. You have to have rules in place that don't allow you to do this. So if you don't have these rules, if you don't have your setup rules, if you don't have your setups graded, so let's say, there's a breaker and there's no gap, no fair value gap, just a breaker. Let's say you call that a C setup. It's just a breaker. It could work, but it's not really the highest probability that I can get. So are you going to trade your C setups with your A plus risk? I want y'all to listen to what I said. You can't trade your C setups with your A plus risks. If you're going to trade a C setup, you need to have a C risk, meaning you're risking less because the probability is lower that trade is going to work. Now, let's say you see a breaker, a fair value gap. It's at the 62% on the OTE, and it's an order block. And that's your A plus setup. Are you going to trade that with C risk? And I've done it. I know y'all have probably done it. You take that terrible trade and you put on 10 contracts. But when the perfect trade is there, you're like, why did I only do 1 contract? And you know why? Because you're traumatized from the C setup that you put A plus risk on. Literally, it's all emotions. It's all psychology. And I struggle with this. Even to this day, it's hard. You have to show up and do this every single day. It's not just, well, I had good risk to reward. I had good risk management yesterday. I had a great day yesterday. I didn't spiral. I didn't break my discipline. I was really disciplined. I didn't break any rules. And then the next day comes and all that goes out the window. It's not just a one-day thing. It's an every single day you open your chart. You have to have these rules and these setups, and you have to abide by them, regardless of what's going on the outside. You might see someone, and it's really difficult on the internet comparing yourself to other traders. You might see, well, P-Dub made $20,000 today. I can do that too. Honey, you don't know what P-Dub risked to make $20,000. He might be risking $10,000. That might be your account. You can't do that. You can't compare yourself. This is all hypothetical. And none of this is financial advice. But you literally cannot allow yourself to let others persuade you to break your rules. because I'm guilty. I'll be like, well, I lost that trade, but they won this trade. So if I look like they did and do what they did, I can get this back and some. And it doesn't work like that. You have your rules and your setup in place for a reason. And recently, one thing that's been helping me, I've never heard anyone say this before. Maybe Pete has told me and I didn't listen, but reward yourself for being disciplined. Reward yourself for following your rules. This has helped me, like, it makes sense in my mind. So let's say you're starting with a small account and you do the math, you pull up your spreadsheet and you're like, well, if I make 3% a week, after a year, where will I be? If you're starting with a small amount, a couple $1,000s, you're not going to be very far after a year. You're going to be like, maybe 10 grand if you're starting with like 2 or 3,000. But that means you have to stay disciplined for an entire year and not really, like, I'm not going to say not make any money, but in trading terms, you're not making a lot of money that you see other people making allegedly, right? So reward yourself. Let's say you have disposable income, but you're scared to put it in the market because you don't want to lose it. Well, reward yourself for being disciplined. So let's say you go an entire week without breaking a rule. Reward yourself by contributing to your account. So not only are you scaling by following your rules and trading correctly and, having a good risk to reward, you're not risking too much. Not only are you doing that to grow your account, you're adding to that for doing those things, for contributing, or for not breaking your rules, you're contributing. That's your reward. So if you start to do the math, and actually, I'm going to pull up a spreadsheet.
Also, too, like, to add on top of that, while you're pulling that up, like, think about, like, if you start out with a $2,000 account and you get it up to 10, you know how crazy amount of percentage you just grew your account in a year?
Yep.
Like, you just 5x your account. So think about if you did the same thing the following year. I mean, you 5x 2,000, you 5x 10. I mean, you're on to something there. So just, think about percent, not the money.
Exactly. So let me share this spreadsheet, and we're going to start with a small amount so y'all can see what I mean. So I don't share. Start screen, share. Okay. So let's say, and this is a spreadsheet I made, you can put your numbers in it however you want to do it, right? So I just put it at $2,000. Now, let's say you have a weekly goal of 3%. So you can see here that we're doing the $2,000 times 3%. So this would be your weekly goal, $60. That's 10.5 points, not even, on the MES, right? And you're risking 1%. So you're risking $20 per trade, right? Which these numbers may not be realistic for starting. If you want to start with one contract and risk $50, fine, But starting with 2,000, if you stick to this, and I want to get rid of this. So let's just do, actually, because I already have these in here as if you are depositing. But if you're not depositing, let's see what the numbers are. And there's probably a better way to do this, but I made this quickly on the fly.
I mean, just depends on how many weeks you get.
A year, I think, is in here.
That's more than a week. That's oof.
Okay, so let's say
either way, still percentage wise.
Okay, cool. So you're starting with $2,000. No, Tim, I can't drag the formula down because I have it on special rows, not every row. Okay, so let's say you're starting with $2,000 and You're risking 1% per trade to make 3% a week. That's your goal. So you win 3 trades in a row, you're done. You lose a trade, you win a trade, you win a trade, you win a trade, you're done, right? Let's say that you hit your weekly goals every week and you don't do anything else. You just grow this account. At the end of the year, you'd have $9,000, right? It doesn't seem like a lot. From 2,000 to 9,000, the percentage is crazy. Like you quadrupled your account and some, right? But let's say you're disciplined for 52 weeks. You should reward yourself for that discipline. And it's a struggle because you might be disciplined all the way till you get here. Week 19, you might have a bad week. The market might be trash. Anything can happen, right? And instead of following your rules, you're like, fuck it. And you spiral like out of control, right? And you go all the way back to like week 5. So now you've not wasted, but you've gone 20 weeks and you feel like you really haven't gone anywhere. That'll drive you crazy, like literally. But let's say instead of just waiting and trading and being disciplined, and you don't have, you have the capital, but you don't want to risk it right away. You want to make sure that you're going to do what's right with that money, right? So every month that you're disciplined, or you can do it weekly, you can do it however you want, but reward yourself by contributing to your account. I don't care if you lose 3 trades in a row. If that's your rule, if your rule is, hey, I lost 3 trades, I can't trade till next week. If you follow that rule, you can contribute to your account because losses are going to happen. So let's say you contribute to your account every time you're disciplined. So we add 1,000. Let's say we're disciplined for another month. We add 1,000. Let's say we're disciplined for another month. You add 1,000. And now this is 3 months of being disciplined. Look how these numbers change. That's just 3 months. Let's say you don't contribute anything else after 3 more months and you're still disciplined. At the end of a year, now you're at 20,000. You almost doubled that original, well, you over doubled that original 9,000, right? Let's say every time that you're disciplined for a month, you add $1,000. And this is rewarding yourself for good behavior.
That might be.
And you can do this with whatever numbers you want. If you don't have $1,000 to add a month, you can add 250. You can add 500. It all adds up, but you're rewarding yourself for being disciplined. You're not just giving yourself a boatload of capital. If you have 10 grand right now, you're not just going to give your 10 grand and put it all in there so you can be disciplined for 3 weeks and then go blow it. You're going to reward yourself over time for climbing the mountain. And if you follow this and do this, and remember, this is only risking 1% per trade, and your goal is 3% per week, which is attainable for the most part. You're going to have losing weeks, but as long as you follow your rules of if you hit, 3%,
and these are
lose
not
3 trades in a row or whatever your numbers are, you're not going to blow your account.
Yeah, and these are not all wins. This is just the weekly goal met. So you're going to have ups, downs, start negative, you just have to figure out like where you're going,
So now you're 2,000. If you're disciplined for 52 weeks, that was going to be 9,000. Now you've rewarded yourself, which is going to in turn make you want to be more disciplined, is a much higher number. And it gives you a goal to want to work for. It makes it real. Your 3% goal is now $1,000 a week, $4,000 a month. That replaces most people's income in this country. Maybe not yours if you make good money, but it's close. It's good. Who wouldn't want an extra $4,000 a month? Even if you only make $2,000 extra a month. Let's say you have 2 red weeks. Your discipline stops you from blowing your account. Your discipline allows you to still make money that month.
Mm-hmm.
So reward yourself. Most people are always like, well, I broke my rules, so I can't do this. Well, what happens when you don't break your rules? Are you going to reward yourself for that? Or are you just going to be like, oh, I didn't break any rules? Because that gets old quick. Trust me.
Oof.
So that's my little soapbox. That's my little psychology rant. P-Dub, I'll let you take it away.
Love it. Should we take any questions or no?
We can do some questions. Anyone have questions about that? I'll share the spreadsheet. I'll put it in the description if you guys want it. Let me look at the comments.
Thank you, Lex. That was really good.
Yeah,
Also, me, I'm kind of crazy, but I'd be like, look, I put 12,000 in and I grew it to 38. I'm gonna take this 12 out and go have some fun. But now I got 22. It's still 10x, almost 10x my money. And now I'll take this 22 and grow it the same way. So that way now I'm risk free. All my capital I put in is gone. I took it from the market and the market paid me.
Yeah.
Another way to
And,
do it.
and at that point, now you're risk free.
Yeah, just not crazy though at that point.
Yeah.
Can't
I
just
mean, hey, money is money. If you can make, and it's just the law of big numbers. If you can make 3% of 2,000, you can make 3% of 200,000.
oh for sure. It
So,
only it only gets
Tim,
worse.
what if I'm unemployed? If you're unemployed, you don't need to be trading just yet. Obviously, this is risk capital. So I do want to preface that. This is not financial advice, but when you're trading in the futures market, I consider that the riskiest form of trading possible, that and options. So you need to have your foundation built. You need your emergency fund, you need your shares, and you need to have a good routine. And then you can start trading in the futures market. But if you have $5,000 and that's it, do not put $4,000 in the futures market because this is going to be gone and then you're going to be sick.
Exactly. I think there's a question that said, how much
How
should
much
they
do you
start?
recommend someone start with? That's up to you. I can't tell you what. I don't know your pockets. I don't know your situation. I can't
I
tell
mean, if
you what
you
to
want,
start with.
yeah, I mean, if you want to do the MES and risk 2% per trade, 2,500 is probably the best way to start because that way you're risking one contract, $50 on the MES. And that way you're only risking 2% of your account per trade. So you can
So
take a
that's
10 point stop and go from there if you need one.
yeah, that's the bare minimum. Like,
To
and
me,
and we don't know your situation. If you have $1 million and you were like $2,000, you want to start with 25,000 because that's your scale. Go for it. But you don't have to have a lot of money to start this.
also attain the skill, not the money. Because you can have 250,000, it's gonna be down to 100,000. You go in this futures market thinking you can trade. And if you're not disciplined with your like whole life, then what's the point of coming in here? Like if you don't wake up on time, if you don't do what you're supposed to do, if you're not a person of your word, if you don't keep your word to yourself, to your family, to your friends, and you expect to be disciplined in the futures market, you lying to yourself too. So
Yeah.
have
Do
self-reflection before you start.
do y'all recommend combines? Okay, so I'm gonna speak on my soapbox about combines real quick. I've taken a bunch of combines. I hate them. I can't. It's the pressure that it puts on me. It forces me to take trades I don't want to trade. It's the time limit. When I'm trading my own money, I don't feel rushed. I can not trade for a week if I want to. I don't like the time limit. And then I also don't like the fact that one, you have to split your profits. Two, let's say you pass, and then let's say you build the cushion, and let's say your account is up 6,000 or whatever, and you're working on building your cushion. So when you can get to the point where you're risking, your 1 or your 3% to make your 1 or 3%, and then you withdraw that. I don't like that. If you have one bad day, let's say you hit that trail and drawdown, all that's gone. All that work is gone. So if you don't withdraw, that's not your money. I don't like that. Granted, you have your rules and all that. Personally, for me, it's not for me. It's a rabbit hole. You could pass, blow it, pass, blow it, pass, withdraw, blow it. I just, it's too iffy. Like, and then you have to split the money at the same time. I'd rather trade my own money personally. Whether that's a large scale, small scale, that's just how I feel about them. But if you don't have any, let's say you only have $100 to risk and you're ready to trade live, at least you think you are, you can go for it. I mean, you can. It's a good way to get quick capital if you're that good. But most people aren't that good at that stage. If you were that good, you wouldn't only have $100. That's how I feel.
Well, yeah, I mean, yeah, I guess my opinion is like similar but a little different. Like, I mean, you can, I would say the biggest thing about combines is if you need discipline taught to you, they'll definitely teach it to you because you're going to keep losing until you become disciplined. The problem with that is you'll find yourself um, putting out a lot of capital and not a lot of reward because you're undisciplined. Now, if that helps people, great. But if it doesn't, then you have to really be at a point where you understand. It's almost like like it's almost almost like Apple, like they get their things from like subscription services, right? Like in some respects, like when you're trading that evaluation count, it's sim, and then when you get funded, for the most part, until you got that buffer, it's still sim too, because you can't withdraw that money. And so then they have withdrawal rules, and there's a lot of fine print. So I mean, my thing is, I guess, it's mixed. If you don't have a lot of capital to start, but you have the skill, go for it. I would just say it's not a situation where you say, look, I don't want to put $2,500 in the market. Let me go do this combine. I would say gain the skill, and it won't matter what you trade. That's my opinion on it. Like, it won't matter what you trade if you can trade. So it won't it doesn't matter what you do. I would say the only thing that's a little tough with combines is it's harder to reward yourself. So you have to kind of almost have a bigger vision, and you have to see it as a point of, maybe this combine, once you get a buffer, it only lets you do 1,500 a month. Now I'm saying only, but I'm saying like if you grow it more than that, you can only do 1,500 a month for 5 months. So you got to stay disciplined. Like all of this stuff stays super disciplined. So until you like actually stay disciplined, I mean, and actually I would even slightly change that. I would say you need to get your life disciplined before you start. I'll be a big proponent of that. If you're not disciplined in your life, like it won't matter about trading anyway. But the deals and stuff that they throw about combines, just remember them. They're there to make money, and they're there to market, like, and have marketing tactics. So you just got to remember like what the game they're playing. So if they're offering you a $50 combine, well, they're assuming that you're just going to blow that and you're just going to get $50 from you. So what you have to do in some respects is figure out what they're charging you per month. What is your monthly fee? What is your goals? What are you trying to do? And how can you break that down over 2 months? Hey, you can only pass it. You can pass it as quick as 10 days. In your mind, you're like, shit, I'm about to put all this capital on here and get this combine done in 10 days and then get my money. That's not how it works, because then all of a sudden you don't have a trade every day. Now it forces you to trade every day. Now you're looking for a trade every day. So I would say figure out what they're charging you per month, base it that way, and say, let me take 2 months to build this up and pass my evaluation. Let me take another 2 months to pass my evaluation. So now you're 4 months in, you've taken your time. And then within that 2 months, you probably pass it within a month. But at least you're not giving yourself 10 days, 30 days. Oh man, you're gonna get this combine done in a month. Well, why? And if you're gonna start a combine, don't jump to 100. I mean, not that you're controlling that much money anyway, but don't jump to $100,000, $250,000 account. Because now at a $250,000 account, you gotta make 20 grand, which means you got to risk a lot of capital to even do it. And then you have to pay attention to what is your actual capital that you're working with. They throw these numbers out like you're a $100,000 account, but actually your drawdown is 3 or maybe 6,000. So you actually have a $6,000 account, and you have a daily loss limit of 2,200, something like that. So if you have if you have an account of $6,000, you have to treat it like a $6,000 account, not 100,000, because you don't have 100,000 of leverage. You have 6,000. And so from there, do the math on that. So now let me take a 2% risk on a $6,000 account, as opposed to saying, oh, you can trade 12 contracts with this $100,000 account. Well, you get drawdown for like 3 points, you blow your account. Literally, as soon as you click it, it's gone. Especially in the NQ, it's like grand opening, grand closing. So I would just say there are ways to do it. There are ways to kind of get around it. My personal feelings on it is to attain the skill first and sim until your winning percentage is crazy high. Because when you get live, I guarantee you it goes down. It's gonna go down because you don't have the emotions the same way as you do in sim. So get your winning percentage, get your plan down, figure out all the holes in your game, ask yourself all these different questions. Like and personally in myself, I want to make sure that, like I've said this a bunch of times, but I want to make sure that I can try to play the market and try to play the market one-handed. Like just like in basketball, if I know the person's right-handed, I'm gonna try to take their right hand away. So that's literally your edge. If you don't have an edge on the market to where you can have a point where you can get in and get out, I don't want the whole pie. I just want my pie. I just want my piece. So if you can be able to do that, then yeah, then you can start trading live and see what that is. But those emotions are going to still take over in your head. So I would say it's not a straight line. It's going to be ups, downs. You're going to have some good weeks. You're going to have some bad weeks. You're going to have some even weeks, which is actually the best week you can have. But I say this to Lex all the time. Like the worst thing that can happen is you don't follow your rules and you win. Like, because then you're going to do it again. And then you're going to risk more. So get your discipline and get your skill, and then they can put any account in front of you and you can pass it.
And on top of that, like in my mind, it was like if I pass this combine, they want me to make 3,000 to pass, right? If I can make 3,000 to pass, and I'm not, it's not technically a $50,000 account or whatever account size it is. I'm technically have, six, whatever my drawdown is, 1,000, 2,000, 3,000, whatever. That's the same as trading your own account with 2 or 3 grand and making $3,000. And then at the end of the day, that 3,000 is your money. You're not in a rush to do it, and it's the same thing. And I could not pass the combine, but I definitely turned $1,000 account into 3 grand. So it's like, I don't know. I guess it depends on you.
Oh my God, that's so funny. Do we? I don't know. Do we have any other questions? If not, we go roll. I think that
We have a
we.
lot of we have a lot of questions. How about we let you go and then we'll answer the rest at the end because I have
Cool.
them on the side.
Okay, that's cool. Let's see. I think he shared. Can we share both? Let me see. Can we see that?
Um, yes,
You may
now we
have
can see it.
my window, maybe.
Yeah, I shared it. Now we can see it.
Do you see it? Okay, cool. Okay, I was making sure. All right. So we got the fun in queue. Not that I'm doing that. I was just messing around. But I figured it'd be cool to like have like a fresh chart because I don't know. I always kind of like to see things fresh with my eyes. And so what I have here, if everyone can see this, I literally just have a 15-minute chart, and it's the S&P 500. Yes, it's a continuous one, so it's not the current one, but they're basically the same in this small time frame. And so what I have is these cool little lines um, of 20 days back. And so you can draw this even further if you want, but for the most part, they're about 20 days, 18 to 20 days. Now, the significance of this is you start to find where the market has been in the last 20 days. You start to find the range of where the market has been in the last 20 days. And you start to notice things that the market is doing. And so within the last 20 days, you can literally see, I'll do this little highlight thing. So you can see where the market has tapped twice and then dropped down and created um, triple bottom support, whatever you want to call it. But it has come down here to what I have basically learned a little bit, mostly from ICT, as far as calling it premium and discount. And the way the market is trading, it typically goes from premium to discount daily, monthly, weekly, yearly, to be honest with you. And so what we start to find is the market comes down, runs all the way back up here, and then finally drops through support. And then you see this springboard happen. It doesn't happen by mistake. It doesn't happen by um, random occurrence of events, but that's for another story. But essentially, what you want to look back, and the reason the 20 days is significant is because this is what the algorithm is using to factor in its range. And this is typically what it's programmed for to care about for the last 20 days, 40 days, 60 days, but they use the 20 days as well. So if you actually start to look and you start to set up your chart, what I did there was I went 50%, which basically from everyone that's been around me, you can just call it equilibrium. Up top, we're going to call that premium. And so
Hold
anything
on,
up,
Peter, mute yourself and unmute yourself. There's some type of noise. I can hear it too. I went on mute and I could hear it. So I think it's you. It might be your mic or some
Okay, let me see.
background noise. Yeah, it's your mic. Unmute.
Yeah, weird. I don't even have anything here.
It
Still
just
do?
randomly started. Yeah.
Huh. Okay, let me stop sharing and see if that's what did it. Is
No,
that
I still hear it.
interesting? Okay.
Well, I guess they'll live with it. It'll be all
What
right. It's not that bad. It's just
is it
like
doing?
it's like a ticking noise. Sounds like a coffee maker making coffee.
Weird. Like nothing's even happening here. That's odd. Hmm.
Or yeah, it sounds like a fan. Someone said sounds like a fan. It's weird. I don't know what it is.
Oh, if it's a fan, then that's straight up like my laptop. Is it picking that up? That's like
Yeah,
a really quiet.
that's probably what it is.
Oh, like these gaming laptops. Like literally, that's I don't. Yeah, that's not going away then.
Oh
Unfortunately,
well, just keep going. It's fine.
yeah, that ain't gonna go away. I was about to say. All right, let me share again. It's working hard sharing this screen. That ain't going nowhere. It should chill out for a second. But I don't know. Some people say they don't hear it. So, yeah. So in this area, we want to call that premium. And then we'll copy this over just quickly so we can make life easier. And then we're going to call this area discount. Okay, so what the market typically will do within these 20 days, yeah, it's starting to get louder. I can hear it now, but within these 20 days, the market drops down into discount. Now, when the market gets into discount, typically a buy or trying to buy the market up or bullish intent is typically going to happen. And so typically when you find the market retraces up and becomes bullish until it gets to equilibrium again. And once it gets to equilibrium, the market can make any kind of decision it needs to make. At that point, you're at the mercy of the market. You don't know exactly where it's going to go. From there, it can drop back down to discount, and you'll see it's try to make a decision at equilibrium. And then once the market gets back up to premium, if it doesn't take out that high, more than likely it's going to create a bearish move and push further down. And so what we want to look for when we're in the market is we want to see which way the market potentially can go. And so once it gets up to premium, doesn't mean it can't go further up. It just means that if it actually starts to break structure, which is what we talked about in the last video, it's going to start at least coming back down to equilibrium. Now, once it comes to equilibrium, you see how it's making decisions again. And once it makes decisions there again, if it drops down, it's coming to discount again. Now, here's the key to a lot of this. Once it breaks out of its 20-day range, there's typically going to be one or two reactions. One, there's going to be a complete blowout, maybe a retrace back to that level, and then complete and just keep going. Or there's going to be a move like this, where it goes through that level and then completely trades right back through it. This motion of trading right back through it tells us everything we need to know about this market. Because once it breaks this level, which you see, I randomly drew, but obviously I didn't see that candle. And so once it actually starts to move, you see this highest point. Once it closes above that level, it's coming back up here at bare minimum. And so this has become a bullish move to come back up to equilibrium. And if you look where the market finished randomly on Friday. So when we're starting to look at the market, we want to kind of look at it in a sense of where is it? Discount to premium. Every day when we're looking at the market, we want to see where is it? Is it higher? Is it lower? Some people use midnight price, which is actually a cool thing as well. If you've ever studied that type of thing, you can literally see that the market is coming back to the midnight price all the time. And so we always want to see that no matter what, the market is literally coming back to that opening price. Well, the reason for that is the new institutional day for banks starts at midnight. So the price resets. That's why you see every now and then it'll kind of have an explosive move up or down. And then all of a sudden it retraces right back to it. And then if London drops down or drops up, it comes right back to the midnight price. And then from there, London can start trading into the New York session. And so typically what you're trying to do is when you're technically counting your 20 days, just let it count. Don't overthink it. Like your Saturdays are not on your chart. So you're not going to count Saturdays. There's a small little Sunday window, but that's all included because it technically is trading in that day. So you don't have to worry about a Saturday being on your futures chart because it does not exist. So when you're looking at this, don't try to overthink it. Just take your info line and drag it 20 days from the last day that you're at. Hopefully that made sense. So essentially, this is what we're looking at from a larger time frame. So now if the market is in discount and it's starting to keep breaking structure further down, then we know that it's going to more than likely try to at least come test this level or break through it. Now, if it breaks through it and it actually retests and keeps going, well, then we have to look a little lower and see which levels it's going to come to. But for the most part, this is how the market is trading in the futures market. Is trading constantly. Pretty sure it's trading like that in stocks too, but we're not going to go into that because, as Lex says, what are stocks? So what we're going to actually look at is kind of breaking this down into a little more granular, right? And so clearly I don't have this charted, so we're going to chart with me. And we'll take this away because we don't. Actually, you know what? Let's leave it. So let's look at yesterday, and let's see if this will let me want to make sure I can get out of this because the color part will kind of get a little weird. So let's look at yesterday. So that's midnight, and this would be 8 o'clock, noon, 1 o'clock. Let's go there, and I'll expand all this out, so don't worry. And 4 o'clock. So let's zoom in and see what we got. So now we know on a 20-day span, we're in discount, right? So more than likely, and then the previous day, we broke through that level and started pushing up. So as we start to look left, we want to start marking out levels that we could actually start to come get. And what we mean by levels, when we point out in the first video, is swing highs, swing lows, relative equal highs, relative equal lows if we have some, right here. So those are going to be levels that have stop losses. Whenever someone sees a bunch of equal highs here and the market drops, they're going to be like, look, that's resistance. Next time it comes up, I'm going to sell it down. And if you look at it, the market does a really good job of actually putting that feint in, because as soon as it comes back up, it pushes down slightly and then starts to get it. But once it actually comes down into discount deeper, don't depend on that to actually be resistance anymore, because now it actually has grabbed enough liquidity and it's going to bust through. So depending on the trader that you are, you see it differently. But I would say for the most part, we are saying the same things. Supply and demand is going to get you somewhat in that area. You can say, hey, that's a new demand zone. It's going up to supply. In some respects, that's going to get you somewhat in that area. You can look at it and say, hey, that's structure to structure. When structure means, well, there's an actual structure down here that it's coming to, and then there's a structure up high that we were at before. And so the market's going to trade from structure to structure. That's another way to kind of look at it as well. And so we're all kind of saying the same thing. Whether most people admit it or not, we're kind of saying the same thing, but it's just another way of seeing it. And it's another way of it's another level of like precision. And so when we're looking here, as it relates to today, this was the first level that was taken out. And if you look up, here was the next level. And then here's another level. And we'll drag these over in a second. And so these are all our levels of liquidity, or where our stop losses would be. And if you look, every time we get to those, the market reacts accordingly, and it reacts magically to them. And so if you look, you actually can see from that day how the market trades into midnight price. Now, this is the midnight opening at 38.07, or maybe 38, looks like it may be close to 38.07. So now as we zoom in on the day, you can see all of a sudden that the market is looking extremely bullish. And the reason for that is because we broke through that low, and then we're starting to try to at least head back up to equilibrium. So here's our midnight price. And then if you look now inside of this, and actually, you know what, I'm gonna have to take this away because it's not gonna let me scroll. So let me take this away. So now we know we're in discount, but we're gonna start looking at the market in a little bit different way, because now everything, when we look at it, everything is fractal, right? And so as we start to mark out these liquidity levels, we're gonna start marking out levels of the market that start at midnight. And I'll change that color. And here's our low between midnight and 8. Now, the reason I choose 8 is because 8:30 is usually news, and then 9:30 opens. So that really starts a different part of the range. So you want to kind of see this range before the market starts. So let's make this, let's just do randomly black, it's easy enough. Now, when we expand this out, we start to look and we see, and actually, you know what? Let me just take this back so that way we can walk through this candle by candle. So what you look at, now we want to find our range, right? So everything inside of this is the same thing. So now our line inside here, and we can leave this as our 50% line as well. Now, what you start to see inside of here is the market dropping down from midnight and dropping down to magically equilibrium. Now, they know these levels are there, but they're not technically levels. They're just trading in percentages of discount to premium. So market comes up, makes a decision, comes back into a gap and says, you know what? We're going to go down into discount. Now, once we get down into here, some interesting things start to happen. Yeah, let's keep it green. Okay, cool. So, and then we're going to go, and let's go down to the 5-minute. And we start to see that as the market is trading down, it has one little swing, swings around to a swing high, and then drops. Now, inside of here, we start to see that the market is preparing to become bullish. Why is that? Well, one, we're trading down into discount. Two, if you look left, there is a gang of relative equal lows here that it just took out. Also, there is a gap sitting right here. You see how it comes inside of there and does that and touches the gap. So now we had a draw on liquidity and we have stop losses hit because these are all relative equal lows. So just like we talked about for the 20-day look back, it took liquidity and it has one or two decisions, right? It can retrace and test that line and drop further, or it can trade back higher. And so in this situation, it has decided to trade back higher. So once it trades back higher, it actually is giving us the sign that it wants to go bullish. Now, inside of this realm, we believe that the market is going to be bullish anyway, because in the 20-day look back, it is bullish after taking out a low, and it is traded back through that level already. And so our bigger equilibrium is higher. So we have a reason for the market to go up. This is just a small fractal part of looking at direction inside of the market and using the exact same principles to determine direction. So now when we look, we have a swing low here, which remember is technically liquidity. So now if we have a swing low that is taken out, see how it closes below and tries to retest through that level and can't close above it. And so then it jumps down and we take our liquidity that's over to the left, and then it trades all the way back through to what? Equilibrium. Once it gets above equilibrium, it tries to retrace back down. Cool part about this is that this is significant movement here. Not only that, we have a swing high here that is starting to dictate direction. And so just like we saw before when we did our analysis over here, doesn't that look very similar? Almost looks like the exact same trade, right? And so this is what happens when the market becomes bullish. It's not technically like a complete like blowout. When we look at a bearish setting, the market just drops and people are excited and obviously running around, saying they got a bunch of money. But when we're looking at a bullish setting, it actually kind of takes the stairs up. You hear that all the time: stairs up, elevator down. So we want to start finding out what is the algorithm telling us and what is price telling us that it's trying to do. Once we take out and we start to develop a narrative around what is the market actually doing. And the cool part about this is that everything is timed in the market. So when we look here, here's midnight, starts a new day. See how many times it comes back up and tries to get above this price? Bunch of times. And then it drops lower. Now, this is significant because it drops to equilibrium before the volume comes in to the London market, which happens at 2 a.m. At 2 a.m., the market starts to make a decision. And you see how all these long wicks, they're basically gathering liquidity to go down. But before the market goes down, it's going to manipulate up. And this manipulation up takes this liquidity that has been gathered here, because these are relative equal highs, remember, takes it and then drops further down. And now we're at 240. Remember, 20 minutes before the London market starts. We come up, and then literally at London open, it drops and takes liquidity. So at the beginning of the market, we have come down into discount, taken out liquidity, and have sucked all the way back up and started to trade higher. This is a classic move that happens in the New York Open as well, is when the market comes down, takes out stop losses and trades higher. This is a classic form of manipulation where the market will fake down, but it's been bullish the entire time. Remember, because we're still in discount. Still in discount on our 20-day range. So we haven't even gotten back to equilibrium. And we have the narrative of taking out our 20-day low. And we have the market where we're trying to get back into equilibrium. And now this market has dropped down into equilibrium. Dropped down into discount from the actual days range. So now once we have this, we have one of our fun little patterns that we trade, where the market comes down and sets a low, sets an intermediate high, takes out that low, closes higher, and retraces magically right back onto the low that was taken out, and then runs higher. Not only on top of that, that makes this trade higher probability. We have a gap sitting right here. So we have a reason for the market to go up. Now, if we look at it from somewhat of a supply demand situation, you can look at it and say, well, you know what? The market, the price ran away. So the market is more out of balance. So it has a reason to come back down. You can look at it that way. You can look at it where it closed above this previous high, broke structure, and came back down, which means this breaking of structure tells us that it's bullish. So we have multiple situations that tells us that. And once that happens and the market stays here, the first target it's going to come from is the previous high, because the faster it goes up, the market gets out of balance. So there's an imbalance to come back. If we offer buy side, it's going to be sell side to come down. The faster the sell side comes down, the faster it's going to come right back, because we create an imbalance this way, we create an imbalance this way. And so the market comes back up. And not only did we do that, we created another imbalance. And so if you don't learn nothing else from this, if the market creates an imbalance, it's coming back to it. Or you can hear the term gaps get filled, or you can look at it in the sense of, return to origin, however you want to look at it. But once we start to see, this is what we call our breaker. It's a small candle, not my preferred one, but technically this is a breaker pattern. And so we have the elements that we need to have in here. And I'm not getting into what all those are, but essentially when we look at a breaker, this is what we are looking for. The market is telling us in equilibrium, it wants to go higher. It's not making a decision there. It actually closes above and it wants to go higher. So what happens though is we get it. So it's like happens in the New York session too. It's like the market runs up, and so people are conditioned to chase candles. That's why most of the time green candles are green for greed, red for fear and scared. That's why it's like fear, anxiety, hunger. That's usually what happens. That's why, McDonald's, Wendy's, et cetera, are red. Look at Arby's, look at KFC, like all your fast food restaurants or whatever are red. But let's get off of that part. But essentially the market is very psychological. And so when you start to see that, the green is going to give you that greed envy, like, oh, let me get in, I'm going to miss it. The market preys on this, like preys on you chasing this candle. And so when you chase this candle, you come right up here and they stop you out because they drop straight back down. And so they come right here into discount and then come straight up higher. Now, where does it stop at? Oh, well, it stops at the midnight price. Comes right back up here. They negotiate the price again. And from here, they have decided that we no longer want to trade lower. We want to trade higher because we have broken market structure and closed above this previous high. So we're just going to trade slightly back down into discount and continue higher. So that's essentially like how the market is trading from discount to premium, premium to discount. But once it makes its decision to go up, it has very significant signatures that says we're going up versus going down. So I know that's a mouthful, but that's how I basically am looking at the market, breaking it down from a top view down to a granular view, down to a day trading view, looking at the market that way. Now, this is all London trading. And if you look at it again, we'll continue this and we'll just kind of keep going. The market's in premium now, right? The next day we had big news at 8:30. I don't remember what news it was on yesterday. What was it? You remember that? What was it? I don't remember now.
Retail.
Yeah, I think, retail sales or something. Yeah. So we're getting closer to getting into 8:30 news. So what does the market start to do? If we're going to be bullish, the market starts to trade lower into discount to go higher. Now we're into here and we can extend these out. And you see how it taps equilibrium and tries to make a decision. And this is 8:20. News comes out at 8:30. Look at 8:25. This move here says I have taken stop losses and more than likely I am coming down here. 8:30, the market drops down into discount. Not only does it drop down into discount, what does it do? It fills a gap, which technically wasn't filled. If you zoom in, technically a gap is not filled until a wick or a body passes through the whole gap. So you actually had space here. You had equal lows, which is liquidity, inside of a gap. So you had a reason for the market to come down. So what it does is it comes down into here. Not only does it come down into there, if you look at this, we have a void of price, and we'll get into that in a higher time frame if time allows, if Lex lets me stay on here long enough. You see how the price has a reason to come down and fill this void. So now the market has dropped down into discount, but it has left clues that it wants to go higher. Not only because the long wick and the fact that it closed at equilibrium, we have equal highs up top. And if you look back, the whole market is in discount and pushing back up to premium on our 20-day look back. So even though the news was quote unquote higher, it caused an algo push down that technically it's actually not good news. But you see how the algo basically pushed down and said, nah, it don't matter how bad it is, we're going up. And so what starts to happen is the market starts to push up and it takes out this high and goes straight into premium. And you see how this accelerates and starts to run up. Now, at this point, everyone's chasing the candle, right? This closes above the previous high, and you see how it closes and retraces right back on top of it. Technically, that's a model that a lot of people have traded before. I don't necessarily trade that one anymore because I don't like the risk to reward there, but it is a cool one to catch momentum if you're in it. Now the market trades back up, and look what it's magically hitting. Our levels that we had further over. So it is going after liquidity every time. And so the market trades up. Now we have a reason for the market to come back. We have a gap or an imbalance in price, a gap, ABC gap, shout out Jay the Trader, or an imbalance in the market. We have created an imbalance in the market with buy side. Now we're all the way up in premium now. So at this point, anything that goes, we're just going to decide. Remember, we talked about how the market can make a decision to drop below discount and then retest and go lower, or it can come out and then break out and go higher and break out through the range. So at this moment, they decided to break out through the range. And so not only is that significant, we have come here at 8:45, at 9 o'clock. We have the New York Open coming at 9:30, right? So the market continues higher and we're getting closer to 9:30. Now watch what the market starts to do. This is 9:20. Now, if I wanted to be bullish, the market is going to do what first? It's going to manipulate down first if I want to continue to be bullish. And so the biggest thing that happens here is the market all of a sudden pushes up, remember, to take out liquidity because it wants to go down, right? So if I want to go down in the market, this is what trips people up a lot. If I want to go down, at least algorithmically speaking, I'm going to fly up first and then drop down. Now, not only do we have the market open at 9:30, which here, 9:30, we have big news at 10. So what the market does here is it drops lower and it prepares for the news at 10. This is 9:45. It has taken out a low, sort of kind of tapped on the gap, not really got there yet. Has a reason to come down at this point. So as we look, this is a swing low. And it has taken out liquidity here. We're still in an uptrend, but it has taken out liquidity here. Market drops down. Remember, everything about this day is bullish. Everything about this movement is bullish. Everything about what we're looking at is bullish. Now we're starting to have the market manipulate down. So if we're manipulating down before the news is going to bring it which way? Up. Not only that, now we have the market coming up to the 20-day equilibrium. And it makes a decision to retrace back down, but just in time for the quote unquote news. And so now the news, that's 9:55. You see how all of a sudden at 9:55, it's preparing to go higher without even knowing the numbers. And so now it runs up and takes out that stop loss. I mean, just obviously, if people were shorting it, it didn't go well. And I know some people were, and hopefully they were in SIM. And so the news and the narrative are very important. Timing in the market is very important. 9:30 brought the price up. Before 8:30, it brought it down, and 8:30 brought us into discount and brought us higher. Now 9:30 brought us up to take out liquidity because we always manipulate. And then we drop down into what? A gap. 10 o'clock brought the news higher. See how we retested the equilibrium again for the 20-day look back. Now in this case, we're making a decision. Now here's the other part. We have a low, a high, a lower low, and at the moment, the market is trading higher. So the same breaker pattern, just on a different trend of the market. And so if we're trading correctly, and if it's going to be a breaker, we should expect the next candles to trade higher and to retrace right back on top of here and continue higher to this liquidity that we have marked. And you see how it hits it and goes. And so the market is trading higher and higher. Now we get to another part of the market where we get to 10:30, which is technically an hour before London close. Well, the same thing that we look at in the New York session, we get into power hour, right? Well, everything about their market for the most part is the same timing wise. So this is their power hour, or this is the time that they start to regulate some of their imbalances as well. So if the market has been running the entire time in their market where we traded down at a discount and went higher, slight discount went higher. Remember, their market is going on since 2 a.m. Eastern. So they've only traded down once and continued higher their entire market. So meaning there's a ton of buy side on their side. And so if they've been running the entire market, they're going to start letting off some steam at their power hour. And so 10:30 starts to come. That's why your reversals on Thursday typically happen. Because if they're trading down one way, all of a sudden they have to flip the script to kind of balance out their market. So if you start to see that, you see how the market is trading down literally at 10:30 on the dot. So this is their power hour in London that's intertwined with ours. And so the market comes down. See how it tries to make a decision here at the 20-day equilibrium. And then what does it do? It goes higher. Now, if it's going to trade down, it's going to start to push higher. I know that sounds counterintuitive, but the market will manipulate and try to go higher. And you see how we haven't touched the liquidity yet? Because that was left as a target to come and get. Now we're getting close to our lunch hour. And typically, whatever we do around lunch, we're going to manipulate and do the opposite for the afternoon. Not 100%, but it typically happens. But in this case, the narrative is we're bullish. The narrative is that we're at discount as far as the 20-day look back. The narrative is that we're going to continue to be bullish. So if we're going to continue to be bullish and the market has been running in the London market, well, then in their power hour, they're going to start selling off and letting off a little steam. So it fits the narrative that in our lunch hour, the market is starting to push down And obviously we're past their London close, and then they're settling their money. And so the market pushes down. And then from there, from the lunch hour, it literally pushes up at 1 o'clock. And that's why the market is severely timed. And so at 1 o'clock, the market pushes up, and we are starting to develop another bullish pattern. And we're not going to go through all of them. I just went through every one of them, but they're repeating themselves. And so this same sell down, right, looks very similar to this sell down, looks very similar to this sell down, looks very similar to this sell down. And so market comes down, tries to sell down, and then basically evens itself out. And now this is where the fun part kind of begins. Market sets equal highs. Remember, this is our old liquidity. This was our pattern here, so we can get rid of that. Market comes down again. And if you look, it creates the same pattern, and we'll kind of go through that in a second, but it creates the same pattern, pushes down, creates equal highs. Now, not only that, we have equal highs up here as well. So now we have two sets of equal highs. But if we want to get them, what are we going to do? We're going to manipulate down first. And so in the last 30 minutes of the market, it will make a decision to deliver price higher in this case, but it's going to make a decision to deliver price. In this situation, everything about this is bullish. Everything about this is staying bullish. We sold down into the lunch hour, which means that we're going to be bullish probably 8 times out of 10. And now we have signatures that tell us we want to go higher because we have equal highs up top, equal highs up here as well. Now, the coolest thing about kind of having this situation of time and price, the market will decide to deliver the price, basically within those last 30 minutes. Now, if anybody's been trading just, stocks or options or anything like that, you look at your charts, and I guarantee you, if you look at the last 5 minutes of volume, that's when all the volume starts to come in. It's kind of a reverse arc, or kind of a I guess a bowl, if you look at it that way, where a lot of the volume in the beginning, nothing in the middle, heavy at the late. So if institutions trade heavy and they trade late, then this is when you should start to expect the price to push higher. And so the sneaky move that the market does is it trades down, sets liquidity, takes it, and then reverses and tries to come and then gets the liquidity and ends the day. So that's how you walk through the whole day, looking at breaking down discounted premium, breaking down your draw on liquidity through your 20-day look back, breaking it down into the 15-minute, going into the 5. So hopefully that was super cool for you.
You just went crazy. Y'all gonna have to watch this a couple times to understand every little nuance that he just described. But if you really want to get good at this, this is what you do yourself. You go back at the end of the day and you break down your chart and you see, what did I miss? What did I not see? Like, for example, I broke this chart down last night. I think I posted it on Instagram, but I missed that we were still bullish right after the open, and I didn't realize there was 10 o'clock news. And I hit my goals Wednesday, so I stopped trading, but I was still simming. I simmed a short right into that news and didn't realize it. And someone tried to tell me they could trade news the other day, and the reason you cannot trade news is because your orders will get skipped. So I was trying to sell at like 38.30 or something like that, and I didn't get filled for the sell until 38.35, and then my stop got hit at 38.38. I think that's around the numbers. I can't remember the exact numbers, but I was trying to sell. I ended up only taking a 3-point loss, which is good, but at the same time, you can't trade that. It will completely jump your stop. It will completely stop you out. Like, I could have gotten filled 10 points lower. You never know. So It's best not to trade news. I didn't realize there was 10 o'clock news when I simmed that. And then I obviously realized, okay, we definitely want to continue to be bullish. So I waited for us to trade back down, and then I took it long towards the end of the day. But that's how you break down price. That's how you back test. that's how you figure out what are you looking at.
Yeah. Hopefully that was cool.
You want to do some questions?
Yeah, let's do some questions now.
Okay, I'm gonna go back to the ones from
Good Lord,
earlier.
good Lord, let me get some water. I go a long time. I feel like I went a long time now. Now that I've like come back out of it.
Not too long. You know, it's all good. We're here to give it away. So questions from earlier. How do you improve your risk to reward ratio? Example from 2 to 1 to 3 to 1. It really depends on your setup. So you can have a setup, if you're trading on the hourly, your stops are automatically going to be wider because it's a longer period of price, right? You want to find your specific setup and then find what that A plus is. And that A plus would be like, okay, if I put my entry here, I'm really only risking 3 or 4 points. And then if you're going for 10 points, that's how you improve your risk to reward. It's just a matter of finding the tightest range that you can with your entry as close to your stop as possible without really, it shouldn't go here if I take this trade. So that's how you improve it. I mean, there isn't that much more to it.
Yeah, I look at it as like having those like for me, I'm always trying to get like 10 points, right? Everyone that's heard me talk, I've been basically kind of going for that now. But I'm also like not arbitrarily trying to get 10 points. Like we're trying to go for liquidity when we're trying to get that. Now, if there's a bigger move, I'm going to take profit at 10 points and then runners are going to go higher. So therefore, in essence, that's how I kind of start to elevate my risk to reward. At least to me, I'm never a all or nothing trader. Like I'm not like if I get in with 4 contracts, I'm not getting out at 4. I'm probably going to take 2 or 3 off and try to wait for and hold one for a bigger move. Or if there is like a 20-point move, I'm going to take some off at 10, some off at 15, and some off at 20. So your average is never going to be like, oh, 4 contracts for 100 points or 30 points or 40 points. It's going to be an aggregate of selling. So that's kind of how I do it.
Let's see. You use Tradovate, right? And do they have paper trading? Yeah, so I use Tradovate. PW uses Tradovate, but he's leaving, I think, soon. But that's a different story for a different day. That you can paper trade on Tradovate. I don't because it's too close to my live account. So I just completely log out of Tradovate and I log into Paper Money in TradingView. So that way when I'm watching, even if I get the itch, like I can't physically do it without logging back in, and that's doing too much. But yeah, you can paper trade on both. I don't know if you have to pay for data or anything if you're paper trading on Tradovate. I'm not sure. I have the data because I'm live trading, but so I don't know. But I know if you do it on TradingView, you just have to have Pro or higher, and then you pay $4 a month for data if you're just trading like the ES and NQ, YM, blah blah blah. But yeah, you can paper trade that way. Someone asked, why don't you trade P-Dub? Someone asked you, why don't you trade the YM because it has bigger swings, or what's the reason for that?
Carl, I find that it's calmer. ES literally like is kind of a mix between, and if you think about it stocks wise, right? The Dow is 30 companies and the ES is 500, the NASDAQ's 100. So you get wilder swings with the lower companies the lower the amount of companies that you have, and ES is typically somewhere in the middle when you look at kind of aggressiveness. Now it's kind of the slowest out of the 3, and that's fine by me. It's got the heaviest point value, so that's always nice. I mean, bonds are a different story, but the NQ moves too wild for me. It's not that I can't trade them, it's just that I like consistency, and you can get hit with a lot of random like stop loss hunts in the NQ. It trades closer to a currency to me, and so I don't necessarily love currencies unless I'm using like a lot size forex model. But in futures, you ain't got that choice, so no thanks.
Since TOS's on demand is always very slow, is there another platform that allows back testing similar to on demand? I know NinjaTrader, you can do market replay. You could trade it, you can actually do market replay. I've never done it. I know you have to pay for it. It's probably like $10 or something. But you can do it that way. Or you can just do what P-Dub just did on TradingView and literally go candle by candle. You just can't actually enter the trades yet. They did say it's coming, so we'll see when that comes out.
I know that would be cool.
But I think if TradingView drops that and then they allow you to log into your broker on mobile, they'll wipe everyone out of the water as far as trading.
There's another one too, but I'm not sure where you got to connect it to, but it's called like soft for like, and it's soft like, and then the number 4 and then FX. You can do it for Forex, but the reason I'm saying that is you can use the US 500, which is technically Forex, but it's the same as S&P 500. So I just don't know what platform. I think it's just an actual platform, but I'm not positive it has to connect to MetaTrader 4, which I don't really like. So I'm not sure if you have to do that, but just maybe look that up and see.
Cool. Oh, someone said Tradervate is $49 a month for Market Replay. So there you go.
$49 a month?
Yeah.
Wait, what?
Yeah, I guess you have to pay for that separately to go in and back test. But
oh Lord, I mean,
I just go candle by candle.
I mean, yeah. I mean, it's probably worth it.
Okay. P-Dub, do you trade ICT concepts?
Yeah, some of them. I mean, not everything. It's a common. Like I think in general, we're a conglomerate of everything, right? Like think about anything that in life. You didn't learn it from one person. So I learned stuff from Jada Trader. I learned stuff from Sending a little bit with the supply and demand. I learned some from ICT. Now, like I would say the more predominant percentage is definitely ICT. But looking at some of the things where you just basically learn how a candle prints, that's no one. That's just me staring at the charts. I've looked at hundreds and hundreds of thousands of candles before I went live. So I can tell you, like, and people that have traded with the bomb bullies, they know what a candle story means. They know what that means. They know what that word means. So, yeah. So if you know how a candle prints, you know where it's going to go. You know the likelihood of it's going to be bullish or bearish. So that helps you in your trade when you're looking at patterns and combining discount to premium, liquidity, gaps, etc.
Is there a winning percentage that you aim for? 100% is not attainable, but is there a number you personally look for?
No, just hit my weekly goal.
Yeah, same. I mean,
as long as you take a positive risk to reward trade, you can win 40% of your trades and still make money.
Yeah, literally. So I mean, it isn't so much as I want to be a 90% profitable trader as it is, well, I'm only risking this much and I make this much and I win. So it doesn't really, you literally, like P-Dub said, you could be a 40% hit rate and still be profitable. So it just depends on your setup, your risk to rewards, and your management skills.
Yeah.
Let's see. Okay, that's from earlier. Let me scroll up in the chat and see if there's any more.
I like it too, because I got time today. Like 8:30 in the morning, I'm literally having a juice trip and just like chilling.
Yeah, P-Dub would stay out here all day if we let him.
Yeah.
Let's see. These significant signatures in price, is there an endless amount of them? Genuine question, or can one practice and recognize them all? I'm assuming that's about breakers and price action.
I would say, well, do you want to answer that, Lex?
Okay, so I would say, yeah, there is an endless amount of them. You will see things that look like a breaker, that's not a breaker. Sometimes I draw things and P-Dub's like, no, you made that up. I make things up. Everyone makes things up every now and then to justify the trade that they want to take. I would practice on finding one model, one setup specifically. Like if you want to see breakers and gaps, only look for breakers and gaps. Don't try to force it. If it's there clearly, you will see it clearly. And those are the best trades. But if you try to force it, sometimes it works, sometimes it doesn't. You're not going to be able to do what P-Dub just did in his little sharing moment. You're not going to be able to see all that in real time after watching this one video. I can guarantee you that. I didn't even see it real time until the second half until lunchtime yesterday, and I realized like, oh, there was news at 10. Okay, we're going to continue bullish and take out this level, and it literally didn't deliver until 4:05 p.m. So I waited 4 hours for price to go up where I wanted it to go. Once I realized I was on the wrong side.
Petty LaBelle.
So you're not always going to be, perfect. But just focus on one thing at a time. If you need to focus on seeing swing highs, look for swing highs. That's it. If you need to focus on swing lows, start there. Start where you are. You don't have to see everything at the same time because you're not going to. It's just not possible. We're human. We have brains. We're not robots.
Tim acting a fool in these comments.
Oh, he always on Tim. Let's see. Okay, so when you did your 20-day look back, was that 20 days from the previous swing high on a high time frame?
Just the 20 days. Just like, so whatever day you're in, look back 20 days and find the high and low. So I use yesterday's or day before or whatever, and then that's when you see it broke the low. So no, just look back 20 days. There's no like magic formula to that. Just use the info line and draw it back 20 days.
Why do you use the 15-minute time frame?
I find that it is the best of both worlds. I look at 3 time frames when I'm day trading. I look at the hour, the 15, and then I enter on the 5. Every now and then a little degenerate 3, but for the most part, I don't really touch anything lower than the 5. So for me, I do all my like weekly, daily, monthly analysis on the weekend, and then throughout the week, my hour is my higher time frame. And then 15-minute has the combination of giving me enough confirmation, but fast enough for me to see the setup. And then once I'm inside of that, I can look at the 5 and enter. I don't know about you, Lex, but that's what I do.
Yeah, I'm the same. And if you see me on a 2-minute, I'm doing too much. But sometimes I will look. Sometimes I just can't see it clear enough, but I know it's coming.
You about to spiral in 2 minutes.
If you see me on anything lower than the 5-minute time frame, I'm probably doing things I'm not supposed to be doing. But sometimes it works, sometimes it doesn't. But like Pito said, breaking rules and it working is the worst thing that can ever happen to you. All right, what's next? So I'm assuming this was the low in the chart you were showing, the low in London. What makes the low of the breaker? What makes that low you started with more significant than the other swing low to the left of it? So I think that was at 3 a.m.
Oh,
Drew the start of the breaker. Why did you use that low rather than the ones previously?
Oh, because we hadn't taken out a level of liquidity yet, and we haven't gotten down to discount yet. If I'm remembering right, the other one was at equilibrium, so it wasn't at discount yet according to that range. If I'm remembering that right.
Yeah, I'm pretty sure that question came in when you were drawing the breaker, the original breaker from that night.
Yeah. And also you can start drawing it that way. The cool thing about breakers is you need 4 confirmations. So you can still do a low and a high, but if it doesn't actually retrace back up, then you got to start again.
Yeah. Someone said, what is QML?
Wait, what?
What is QML?
Next question.
Not today.
Next.
May said it's an AP course.
Yeah, next video. I really haven't perfected that, so.
Yeah, no, I can't talk about something that I haven't done live.
Exactly.
I'm not gonna trade that live.
I have not.
I need more time.
Well, I'm months away from that. No thanks.
Let's see.
It's a Forex concept. Just Google it. I mean, it's
I think that might be it. Oh no, it's not it. Are you? Well, you answered this. It says, "Are you adjusting the 20-day equilibrium level each day?"
Yes and no. Usually, if it stays inside of the range, no. I really kind of only adjust it if it breaks low or high, because other than that, you're basically still inside of the same range. So once it breaks a low, then I'll start that low with the next 20, with basically the next 20 days, if that makes sense.
Cool. Do you all trade options while trading futures outside of the indexes, or do you feel like the average person doesn't have the bandwidth to trade both during a trading day? Okay, for me, no, I don't have the bandwidth yet, but I'm still perfecting what I'm trying to do. P-Lab, on the other hand, he over here, I think, I don't know. He trades, so.
I trade options, but typically it's more along the lines of using a higher time frame to trade options, because data is a hoe. So essentially. So essentially, I'm using like the daily to the 4 hour, and I'm more or less predicting a move. Just like you saw in that aspect where we thought we'd be going back up to discount, and we already have like three parts of the setup done. Then if the market comes down, I'm going to buy something with 2 weeks to a month. Every now and then I'll do some 0-day SPXs just because that's kind of like how I do. And if you see the market drop down like that futures trade, then I know equilibrium is back up to 38.40. So once you see the 20-day look back, like on Friday, that's why I got an SPX 38.40 the day before.
Yeah, and I will say, I was doing it for a while. I personally don't like to try and trade like SPY or SPX while I'm trading futures because let's say I'm in a SPY swing, I'm in calls because I think the market's going up for the week. I will let that bias sway my intraday trades. I have to have a clear, just every day I look, I don't know what's going to happen. But if I'm already in a position and I know I have money sitting over here, I let that bias mess with my hand. So for me, I don't do it. Not yet, anyways, again. Maybe one day, but I'm not there yet. So I think it's really your personal preference.
Stay focused.
And theta. Ooh, I can't stand theta. Tim said, what if the candle is red and price comes down to the straight line 20 EMA?
That's why we don't answer your questions. You talking about if it's the 15-day or the 14-day EMA across?
And RSA is at 70. Yeah. RSI.
Yeah. Bounces below the EMA right before open. You buy it up into the EMA. Yeah, everyone knows that trick.
Okay, P-Dub or like, how do you wait until liquidity has been taken to start looking for breakers or ATMs? I see a lot of high lows, higher highs, vice versa.
It's the 4 confirmations. It's not just the narrative has to make sense. And basically what we just went over, not that everyone has to remember all that, but just kind of go through the video of how when the market is trading down into discount, then we should be looking for a bullish move. And if that actually, if the actual story is the low, high, lower, low, and then it closes above that high, and we've already become in discount, then the bullish move makes sense. If we're in premium and then opposite happens, then the bearish move makes sense. So it's not just the candle pattern. The narrative and your thesis has to match up with the candle, not just it's a low, high, lower, low. Let me go take it.
Someone said on the 15-minute chart, was that a breaker formed on July 14th at 4 a.m. that the market came back and hit during London session on the 15th at 3 a.m.?
Man, that's specific. I mean, maybe it is.
I have no idea.
Like what answer?
Hold on, I'm about to look on the 15 minutes.
Wait, the what candle?
On July 14th, the 4 a.m. candle.
Candle.
Where's the 14th? Okay, so the 4 a.m. candle.
No, it's not. Well, the 4 a.m. candle's like a doji. No, that's not a breaker.
Yeah, I see what you're saying, but no.
That's not a breaker. That's an order block. But
anyway. I see how it came back and hit it at London, but no, because there's no.
So the problem with this is that it's a retracement into the order block at the 2 a.m. candle. And then it pushes down, and then there's a green candle at 3:15, and then it pushes further down, and then there's another order block form. So I understand that could be, but there's really no higher high at that point. But it's very close. I mean, it's no. I would say the end result's the same per se. Yeah, the 4 o'clock candle. No, that would not be a breaker there. But it's a retracement into a gap, and then it pushes further down.
Yeah, one thing I will say is you skipped a lot of candles. Like, you don't skip all the price action. There's important price action in there. So I see a bunch of lower lows a bunch of lows and highs in between that. So you can't just skip the middle because you want to. I always start at the intermediate higher low. That's like yesterday's higher low, not the current one that I would want to be looking at. But it is a significant price level. Yeah, you can tell the algo is working in there because the gap shot through it. So is that a significant price level? Probably on like a weekly or a daily chart that we don't see, probably. But that isn't specifically a breaker, no.
That was a specific question, though. I like it.
It was.
Yeah, he or she had that one highlighted.
I think that's it. Hold on. Don't let me speak too soon.
Oh man, we've been on what, an hour?
Okay, here we go.
Dang.
Are there certain things you see in price action that alerts you to trade the London session or before 8:30 news on a given day?
Yep. If we have big financial or economic data news, then I know for the most part the market's going to be trashed before it. Like CPI, like typically they'll tip their hand the day in New York session, but typically leading up to it, if we're waiting on an actual result, there's really nothing that's going to probably happen. It's probably going to stay in a small range, like what happened Wednesday. The range was what, 10 points before the news came out. So, but leading into, yeah, I mean, honestly, like sometimes because it's early here on the West Coast, like if I see the Asian like just selling off or running up or whatever, I'll be like, well, something significant's happening. And then you just basically just see the price movement to me. News itself, I'm kind of somewhat curating the news per se. So I wouldn't say I usually try to anticipate like something's going to happen before it, if that makes sense. I don't know. I guess I don't have the best explanation for that.
Yeah, I personally I like trading before 8:30. I feel like I find good little setups before 8:30, but it depends on the news. If there's no news at 8:30, always to go. But if there's something like red folder, something that I know is going to move the market, like CPI, I'm not going to be in that trade at 8:30, and probably won't be in at 8:28 either. I'll get out regardless of where I am because I'm not getting stuck in that news candle. I hate news candles. All right, I think that was all the questions. I'm at the bottom now, so.
Sweet.
Well, thank you, P-Dub.
That was fun.
Someone said, when's part 3? We need the QML class.
I can't teach something I don't know. So I don't know that. And I don't even know if I want to even go there. I think there's enough here for people to be profitable and find a model.
Yeah, I think, you did. That was a great explanation of literally a whole day of price action. So take your time, y'all. I think Tim asked this earlier. If I watch this one video, can I go live? Absolutely not.
Tim's so crazy. I love Tim.
But yeah, take your time. The market is not going anywhere and it's unforgiving. So if you don't, it's going to punch you in the face. But thank y'all for tuning in. P-Dub, thank you for coming. And we will catch y'all later.
Take it easy.